Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. We have a lot to discuss this week on the financial and economic front, and we're going to be joined by David Crowell here shortly of Mortgage Network to discuss some of these items in more detail. But before we get to that, I'd like to introduce a couple of the headlines that you've probably been seeing this week and discuss a few of those factors that we're going to be carrying into the second half of the show. So first and foremost, the headlines that we saw this week. Number one, the S&P Case-Shiller Index. That's an index of real estate prices throughout the country, and there's this is the 20-city composite of the S&P Case-Shiller Index, and it ticked up pretty significantly to the highest level since last year. It's the highest level in years, but it's ticked up significantly since last year. And you can see here, these are real estate prices around the time of the bubble, 2004 through 2006, and you can see how drastically they came back down to those earlier levels from 2001, 2002. And here, this is present day, you can see we've sort of ebbed along, but we're really starting to see a spike in those real estate prices. That's a very positive sign. It's leading to some speculation that we could be looking at a bubble again, of course, but it certainly, when you look at this 20-city composite, doesn't really make you think that we're quite in bubble status yet. But we're definitely seeing some positive indicators there in real estate prices, which improves people's psyche in general and just the wealth effect that it has on people in general. Second headline, and you're sort of seeing a yin and a yang here, is this bubble speculation versus the fact that we're still looking at a pretty tepid recovery overall. We're not seeing tremendously strong numbers when it comes to GDP or overall unemployment. However, we are seeing definite increases in property values, et cetera. I know you won't be able to read this on TV, but for my reference, what this basically shows us is the 20 different cities that are included in that Case-Shiller Index, and the fact that a lot of the so-called bubble markets, the Phoenix, the Atlanta, the Las Vegas markets, have increased tremendously over the last year, say in the neighborhood between 30 and 40%. So while we're looking at just a broad uptick in the overall 20-city composite index when it comes to real estate prices, some of those markets that were bubble prone back in 2006 are definitely seeing some of those same characteristics again in today's market. So that's very interesting, and it's fueling some speculation that we could be looking at that bubble. However, as I said before, we're really not seeing overall broad market dynamics that are very positive, or economic dynamics that are extremely positive, that would lead us to believe that that bubble is going to be pervasive. It really is much more tepid, and the unemployment picture is one that I think definitely supports the tepid conversation. We're seeing some positive numbers, but it's definitely not to the level that it needs to be to show that this economy is really has got some heat behind it. It's definitely in a much more tepid pace right now. This morning's unemployment numbers, especially, were definitely less than expectations. While positive, we're definitely less than consensus, we're less than expectations, and the market's responding to that. But interestingly, even though we had somewhat lackluster unemployment numbers today, yesterday, on speculation that we were going to have positive unemployment going through the roof, we saw a big spike in interest rates. And what you see here is the 30-year Treasury. This, from this point here over, is the last 3 months. And you can see that the increase in rates over the last 3 months has been significant. And this is the 30-year. It's across all maturities, across the 10, 20, 30-year Treasury. We're seeing all of these rates increase. But you can see yesterday, very, very light here, that we had a big jump in the 30-year Treasury, 10-year Treasury, et cetera, just on pure speculation that the unemployment level was going to be better than it was today. And now today, as of this morning, that rate has come right back down again. So we're seeing this really interesting yin and yang, or sort of a shooting match between the bond market and the equity market that's really being managed or refereed by the Fed. And it'll be interesting to see how this sort of plays out for the next couple of months. So we're going to be joined by David Crowell to discuss these issues in greater detail in the second half of the show. Please stick with us. This is Money Matters. We'll be right back. Welcome back to Money Matters. We're joined by David Crowell of Mortgage Network. Thank you very much for joining us today.
Thank you.
So we have a lot to talk about today, David. We just went through a lot of sort of interesting economic and financial news that's going on right now. Finally sort of seeing some stuff bubble that we haven't been seeing for a while. I feel like we've been discussing the same themes consistently for the last 2 years, and definitely starting to see a little bit more movement. So what are your thoughts on that? What are some of the things you're seeing in light of this, economic news that we're looking at?
It's very exciting. The national economic news is more exciting than it appears. I mean, the Fed is...
For people like us.
For people like us. But I do believe it translates to everybody who's watching. I do believe it translates. First of all, interest rates, the interest rates that you see as a consumer for mortgages and so forth, have increased about 40% in the last 30 days. So they've gone from 3.5% to 4.75%.
Wow.
In a 30-day period, 45-day period. Now, that's a lot, and that's
that is a lot.
And that's more of a bump in either direction than has occurred in the last 4 years.
So what does that translate to? I mean, a couple questions. What does that translate to in terms of the actual cost of a home if you are buying your average, $500,000 Hilton Head house?
Figure for $100,000 of borrowed money that the change in interest rate is about $90 a month.
Okay.
So if you, on a $500,000 home, borrow $400,000, then that's about $360 additional that you will be paying.
Wow. So are you seeing that that's getting people off the bench, or are you seeing that it's pushing them back on, or any difference at all?
The interesting thing is nationally, it's going to have an impact at a certain point. The major national home builders are selling like crazy.
Right.
Absolutely like crazy.
And why is that? I mean, because I thought that we had, excess supply of existing homes.
It's a really good question. That is precisely what we don't have. When we have a recession, one of the mysteries of recession is that economic activity goes down, and one of the things that we lose is housing stock. And we lose housing stock every year of a recession. So it feels like a real estate glut.
Right.
But in fact, there's no houses being created. And houses go off the market, they burn down, they get used up, in effect, year after year. So right now, it doesn't matter at 100,000, 150,000, 200,000 at the lower end of the home market. That rise in interest rates really doesn't impact at all, because it's only about $100, $120, $130.
Yeah. Are you seeing the change or the transfer back yet from the rental economy and a lot of families, not just individuals, but families that wound up renting homes, foreclosed on their home, wound up renting a home, starting a couple of years ago? That trend started, probably 3-4 years ago now. Are you seeing that turn yet, and some of those renters coming back into the ownership ranks, or is that that's yet to come?
Nationally, people are grabbing homes at the lower end. Locally, we always have to remember that we have a completely different economy here. We have an economy here that is driven by retiring baby boomers. People who are 50, 55 years old to 70 years old. They have very, very different needs, very, very different worries, different expectations than the national numbers. What our folks here do is they simply put more money down.
Right.
So
they have those cash, coffers that they
have the cash coffers. So they simply change the structure. Yesterday, I had a fellow, a difficult phone call, a fellow that I've been working with for 6 or 7 months, and I had to report to him that rates had gone from 3.5 to 4.75, and I was not looking forward to the phone call because he's a very precise, very I wouldn't say difficult, but a very precise person. I delivered the news. He said, "That's all right, I'll put an extra $100,000 down." End of conversation. Because at 63 years old, that's the sensible response.
Right. And you don't usually get sensible responses. That's a rare thing.
That's right. And what you're going to see is more and more of that. Our real estate market here is hot. You can't keep a house that's in nice shape on the MLS for more than a week or 10 days, anywhere below $600,000.
Right.
What that says is that people are coming out of the recession and not overspending.
Right.
they're meeting their needs at a reasonable price point.
Right, and I know we've sort of discussed that dynamic before, sort of the new normal and everything. There's also, the opportunity cost factor here, because, a couple years ago, and with interest rates, I'd say maybe, a year or two ago, when people would come to me and they're buying a new house, they'd say put their 20% down, and they would say, should I put another 10% down? And at the time, I mean, every case is slightly different, but sort of if we were looking at it in a vacuum, at the time, my thought was, no, you shouldn't put that extra cash down, because you're looking at extremely low interest rates. You're basically borrowing at nothing when you consider even modest inflation at all, and modest growth in home values at all. And it was still sort of unknown how quickly, as it still is, how quickly real estate prices would rebound. But the markets were poised for massive growth. So 2 years ago, that recommendation of not putting more money into the house, I sort of felt like it was throwing good money after bad, made a lot of sense. These days, as the market's toppy and as we're sort of hitting all these new all-time highs on the S&P and on the Dow, and with bonds being where they are, I suppose that sort of turns that recommendation on its head.
It does. You gave exactly the right advice, and it turned out that it was the right advice
2 years
because
ago.
2 years ago, because if you'd left your money in the market, it would have over the last 2 years increased, what, 40%, 50%, something like that? Right now, if you've got the extra money, 4.5%, 4.75% on an after-tax basis is 2.7%. You can't earn 2.7% in anything, in any bonds at the moment. It's, or at least I believe it's pretty difficult.
Oh, yes, it's pretty low. Yeah, and you wouldn't want to be, if you were getting 2% on a bond, you probably wouldn't want to be there.
So what I see is more and more people making the reverse decision now and just saying, hey, let's have a modest mortgage, a mortgage that perhaps can be paid by John's Social Security payment or Kathy's Social Security payment. Let's link it to something else that's stable in our lives. That expected payment every month that isn't going to go away.
Right.
We'll make the payment with the Social Security, end of story.
Well,
if that happens to be $200,000 mortgage, so be it.
It is what it is.
Yeah.
Along those lines, are you seeing the baby boomers that are moving into Hilton Head and just, I guess, across the nation, are they looking at real estate as an investment? I mean, when they put that extra money down on their home and they look at opportunity cost and they know that they're borrowing at relatively low levels, but they're also looking to have a home that they're comfortable with the payment and they're comfortable with the lifestyle they have there, are they considering it an investment still, or not?
We should do a whole show on that question.
Okay, all right.
We should do a whole show on that question because there's been a complete transformation. Investment real estate is a dirty word. People have come, the 50 to 70-year-old people have come out of this recession absolutely not thinking about real estate as an investment.
Probably most of them had a good bit of it as an investment, had to make the business and the difficult decision to unload it.
Unload it, exactly. And so real estate now is strategic, it is lifestyle oriented, it is about lifestyle comfort, it's tempered by what is financially easy to accomplish, no financial stretch. I mean, 1 in 20 people does a financial stretch at this point. And even when they do a financial stretch, it's only that they are getting the Hilton Head house that they can't pass up and still own the Michigan house, which they're haven't quite yet sold. But right now, that's not such a stretch because Michigan will sell. 4 years ago, Michigan might not have sold.
Right.
You see? But your question is so sensible. It's a complete transformation. Nobody's making the investment calculation right now. Nobody. That's
interesting. And it definitely seems like it's a bifurcated improvement in the economy. We have, the folks with money are improving a lot faster than those that do not necessarily have the savings, more cash in the bank, more equity in their home, et cetera. Those that have that, I think, are really realizing this recovery a lot better or more quickly than others. Are you seeing the same thing?
I'm seeing the same thing. I'm seeing two groups in the society doing well at the moment. The people who've already got money are doing particularly well, top 5%. And interestingly, I'm seeing the people who are just forming families, who are just starting out. they're doing very well because they're able to form the family, get the first piece of real estate, and get completely set up on minimum dollars. And maybe she's a teacher, maybe he's a firefighter, they've got $80,000 or $90,000 household income and very little expense. So they're getting off to a good start.
Yeah. But
they're the only other group besides the people who have really got some dough. Everybody else in between is kind of struggling still.
Yeah.
Yeah.
It's interesting.
Yeah.
Well, we'll have to carry that through the next show.
Yeah.
Well, thank you very much. We're going to actually take this one more step and discuss a little bit about the income needs of the baby boomers and some ways that they might be able to fill that income gap as they're looking to retire or newly into retirement in this low interest rate environment. So please stick with us. We will be right back with the final segment of Money Matters. Welcome back to Money Matters. I'd like to end the show with a couple ideas on how to fill the income gap. We just talked a little bit about this with David in terms of people's budgets when they get into retirement, approaching retirement, and how they're looking to fill that income gap that they might have. So let's go through this real quick. Future income, of course, during retirement is going to be made up of Social Security, perhaps pension income if you're fortunate enough to have that, perhaps part-time employment, and then, of course, investment income is usually used to fill some of that gap. And yet your expenses in the future are either going to be static or they're potentially going to be increasing due to healthcare costs. So let's look real fast. I know I've used this chart before. I like to think about dividing your finances or dividing your savings, your investments into three different buckets. The first is going to be your short-term expenses, and that's usually going to be, your short-term investments, usually cash and cash equivalents. Usually we recommend about 3 years worth of expenses are to be held in that type of cash or cash equivalent, extremely short duration bonds perhaps, because savings investment rates are so low. This of course is going to be supplemented by the income that we just talked about. The second bucket, and we could say a third, of course it depends on your financial situation. The second bucket is going to be the higher yielding, intermediate type term investments. Historically that's always been bonds, higher yielding bonds. In this environment where we have super low interest rates, they're not quite as effective, and I'm going to get back to annuities in just a second. And then of course the other third, or the long-term bucket, is going to be your growth-oriented bucket. This is usually where your 401ks, IRAs, other tax qualified and tax advantaged accounts are going to be sitting, as well as your long-term growth-oriented investments. So the way that this works, of course, is as you use the cash that's in this bucket, supplemented, of course, by the income, you're supposed to have income coming in from your intermediate term or higher yielding investments, and that will then be supplemented by growth-oriented gains that are supposed to come into this bucket, and the whole thing is supposed to revolve around. So what is it that you're looking for in that filling that income gap? You know what that income gap is. You know that it's X dollars. You have your expenses here, you have income coming in here. Whatever the difference is in between is what you're trying to fill, and you know what that dollar amount is when you retire, hopefully prior to retiring. But what is it that you're looking for in that? You're trying to find something that provides flexibility with life's changes, but also security. So one suggestion that I have is you could actually layer annuities. And let's go back to look at this for a second. As an alternative to bonds in this environment where we have very low interest rates, annuities are still pretty ripe with good guarantees, anywhere in the neighborhood of 6, 7, 8, 9%. Of course, there's handcuffs and a lot of other dynamics that we'd have to discuss if we wanted to get into a lot of the nuances of it, but they provide a pretty good alternative to bonds as one scenario. However, when it comes to annuities, let's say for example you put all of your eggs in one basket and you had a total of $100,000 to invest, and you put $100,000 in one annuity, then you're going to be stuck with that one. When you decide that you want to annuitize it, you're going to be stuck with the income that comes from that annuity for life, regardless of whether or not your life situation changes. So one suggestion that I might have is that you layer those so that you can actually annuitize them at different times to provide for more flexibility in your future while still having the security of the guaranteed interest rate, the knowledge of exactly what that income is going to be at that future rate in time. You also have a few other benefits that come from that. Some different providers, some different insurance companies that provide annuities provide different riders, different growth rates, etc., some other benefits. You also have a diversification of issuers perhaps if you do that, so that if something happens with one of the issuers you don't have to worry. And also you have increased insurance because there is state provided insurance on all annuities up to, I believe in South Carolina, it's up to $300,000 per annuitant. So if you have multiple contracts, multiple annuities, then you're actually able to achieve higher insurance levels or higher insurance on your savings, on your investment. So let's look at one illustration here just really quickly. For example, if we have an annuity with an initial premium of $250,000, and this is just one company, there's multiple companies, but all these illustrations are effectively the same. This particular company offers an upfront bonus on that of 10%, so your $250 automatically goes to $275 on your future income base. This is for joint life. This could be for a single life or for joint, but this is for joint life. This individual is, one of the individuals is 70, the other is age 69. So this shows us, and I hope that you can see this at home, this shows us the ages over here and then the value of the account, the income value of the account. That's where you're going to be pulling income from in the future. This is a guaranteed number. It's not a I hope the market does well type number. It's an absolute guaranteed number. And from that you have a guaranteed annual payment. Now once you start taking your payments from this, it is set for life. And if it's joint, it's for you and your spouse's life. But at least you know exactly what that number is. So here, for example, if we were to annuitize at age 74, the initial investment of $250,000, we're going to be receiving approximately between $19,000 and $20,000 per year. There's also some other benefits that go with this, but that's guaranteed for life. So what you can do is you could actually layer these and say, okay, at age 70 I might want to annuitize one and achieve $14,000, but I'm not sure that I'm actually going to need all of that income right away. So if I break this into pieces, then I can actually annuitize later or start taking income later depending on how the contract is structured, and I don't have to take it all now. So you achieve a lot of the benefits that we were looking to achieve with this, of the flexibility and the security of income in the future. So that's just a quick tutorial on how this, on one idea of how you might be able to bridge the income gap in this difficult economy, difficult interest rate economy. Please stick with us next week. We'll be back next week with some other interesting ideas on how you might invest your money in this economy. This is Money Matters. I'm Emily Johnson. I look forward to seeing you next week.